So there's a lot of fear right now in the stock market, with investors waking up and seeing more and more red in their portfolios, and some even heading for the exit sign. But one can only understand why investors are freaking out. With supply chain shortages, China going into lockdown mode, adding more fears to supply chains, bond yield inversions in the US, inflation may soon become stagflation, and to top it all off, a literal war with severe threats of nuclear action. It's a scary time for the world, let alone investors. But rather than put out a video why the stock market is falling, adding more fear to already rattled investors, I thought it would be more beneficial to people to realize what you can actually do from a mental standpoint to prepare yourself for the inevitable theory, the lost generation, the great reset, a changing world order, or maybe even just a recession. So here are my 5 survival tips on a stock market crash, and I'm also going to leave you with how you can prepare yourself to actually take advantage of a falling market. So it seems that I am trying to do my best and stay sane in this massive falling market. Please do me the kind favor, help me out with the YouTube algorithm by making sure you have obliterated that like button. Seriously folks, it really helps me out. So the famed investor Peter Lynch, one of the guys I genuinely look up to, famously once said, "The most important organ in the stock market is the stomach, not the brain." And what Peter Lynch means by this is that it's how much pain you can stomach as an investor that defines you. And I have to agree, this is one of the most important character tests an investor has to go through when the markets are falling and you see red. Do we sell and wait for the bottom to buy back? Do we buy more, lowering our average? Or do we simply just quit the stock market altogether and go and hide in a hole somewhere? And I'm sure if you're watching this video, you've probably at some point in recent weeks thought of doing all 3. There's no sugarcoating it. No investor likes to see the stock market fall. Your portfolio becomes a constant reminder of the pain, tugging at your every bit of emotion and reminding you that you are a loser. You'll eventually start rationalizing should you indeed sell your stocks and get back on the ride up. Those famous last words of majority of retail investors. The market is a compilation of knee-jerking reactions on the upside and indeed the downside. Nobody actually knows if a good news article is going to pump the market up how much, or indeed a bad news article will send it to the downside. Nobody knows how much up or down, or indeed for how long. Still, it doesn't stop investors trying to navigate their way through this turmoil market, trying to time it, even more so in a falling market. So what can you do about it? How can you avoid having so much pain when the market is falling while still having exposure to the stock market? Because we've all been told it's not timing the market, it's indeed time in the market. Sustained sharp dips in any economy or market, or indeed stock and company, are for sure going to make investors worrisome and fearful that it may indeed continue. But there are steps you can take to put times like this into perspective and even maybe potentially benefit. And that brings me on to my first tip, and I bet my bottom dollar that every single person watching this video is doing exactly this. And really, they shouldn't be. We live in a world where you download an app, deposit, and make a trade, and you're in. You've bought the company. It's that quick. And on that, a quick shameless plug, my favorite app is eTORO, and if you sign up via the links on the pinned comment, you will get lifetime access to our investing chat room, where we do complain and panic together, share memes when the stock market is falling. But we live in a world where people are constantly connected to live prices of investments and reminded how successful or indeed unsuccessful they actually are. Gone are the days when you'd call up at the bull pit and get some old bloke to run over to the NASDAQ booth and put a purchase in of 5 shares of Apple at $20. I mean, people used to literally wait on the phone for 30 minutes via satellite to make sure their order went through, and sometimes even got charged a couple of $100 for doing so. There's no hiding the fact that the current system is much more efficient and more connected to the average person, but here lies the big problem. When the stock market is going against you, you keep waking up, seeing red, red, red. You get nervous and jittery and think you're the biggest loser in the stock market, and realistically, you're not. Those who bought Squid Coin are. But we're constantly logging into our portfolios, hoping that the stock market has indeed turned around, thinking that if I just break even, I will sell out. I promise God, I will sell out. And all of these emotions and thinkings that you have are seriously influencing your decisions and not making investors think logically. The first survival tip I have is something very hard I've had to do myself, and that is just simply put, not checking my app every 30 minutes. A new survey found that almost half of investors are checking their performance once a day or more. And Dan Egan of Behavioral Finance and Investing says that looking at your portfolio frequently can make you feel like it's performing worse than it actually is, and it's less likely that you'll invest correctly for long-term success. And more on that, financial planners actually recommend that out of curiosity alone, you look at your portfolio every 2 to 3 months. And I did just swear there, apologies, I'll try and blur it out. And that's why since October last year, I've tried my hardest to break this habit of checking every couple of seconds what my portfolio is doing. I've limited myself to opening my apps just once a day, and to be honest, I'm much happier for it. By doing so, it lets me have a 24-hour cool-off period to make sure I do indeed want to sell or buy a stock. It gives me 24 hours to go and recoup and see what the actual news is. Are the earnings actually as bad as what people are making out? Is it indeed a discount? Should I be buying it? And having this 24-hour period, for sure, I promise you, it definitely helps. I feel that logging into your app every 2 minutes is seriously negatively affecting majority of investors, because it's so easy to see when you're down 20 bucks, click sell, and make you feel that there's a little bit less pain in your life. But I have to ask you, if you go back in the 80s and you had to wait 30 minutes on a satellite phone to speak to an old guy who can't hear you to go and put that sell order in, would you actually do it? Probably not. So survival tip 1 is simply put, do not look at your app every couple of seconds, because it's not good for your mental health and logical thinking. And tip number 2 may seem obvious, but I think this is going to be a bit of a different spin to what most investors are thinking of. And that is, think long-term, not short-term. Historically speaking, for instance, stocks lose 36% on average in a bear market, but gain 114% in the average bull market. The average length of a bear market is 289 days, or about 10 months, where the average bull market is a staggering 991 days, or near 3 years. Bear markets for sure are painful and worry a lot of investors, but overall, majority of markets do indeed recover and eventually turn positive. Over the last 92 years of stock market history, bear markets have only accounted for 20 of those years. Or to put it another way, stocks have been rising 78% of the time. And this is where tip 1, 2, and soon to be tip 3 all come together, making sure you have the longest and best chance of success. We all know bear markets suck, and it's mentally hard to take these losses on a daily basis, looking at yourself in the mirror, calling yourself a loser. But if you're not checking your portfolio every 30 minutes and accept the simple facts that eventually majority of markets will indeed go up, taking comfort that one day a recession or a market crash will soon be over and that you can move on with your life, if you accept these key facts, then you will survive. You will not panic sell, and you will make sure you're set up for the financial future. A study recently showed that 80% of mutual fund managers underperform the S&P 500 over a 5-year period. And why is this? I simply put it down to one simple theory, and that is that when the market is crashing, fund managers try and declutter their whole portfolios in the hopes of just getting a simple 1 or 2% return a year so that they can get new investors to come into their fund and show how good they are. The market fell 20%, we made 2%. But honestly, do not do this. Instead, think of the company you own, or the stock you own is a partnership. Look at the company's performance, the management, the long-term goals, and don't let the stock's actual price in value determine how you feel about the company. It's common for good companies to trade lower in a stock market. It seems that the baby gets thrown out with the bathwater in a stock market crash, which proves potentially it's a good opportunity to buy good companies at a severe discount. Which brings me perfectly on to point number 3, which of course is dollar cost averaging and continuing to invest into ETFs. This is by far the biggest mistake investors have made historically speaking, and why most retail investors lose money. And to be clear, I just want to stress this does not mean keep buying high risk, high speculation stocks in a falling market, because majority of them won't recover. It means that buy a strong ETF tracking the whole market, or buy a company with big cash flows, and more on that point in just a second. But by investing a regular amount in fixed intervals, regardless of the market economy, has proven to be a steadfast way to financial freedom. You're more likely with this mentality to purchase good equities or good investments at a decent discount, which will indeed, in turn, make you more profitable in the long-term future. Remember point number 2, long-term, not short-term. By making regular weekly, monthly, or quarterly investments into an asset is called dollar cost averaging, and if you've never heard of it before, I suggest you go and do some research. In the long term, this will lower the purchase price as you buy lower into an asset, index, ETF, or stock, meaning that when the markets do indeed recover, your profits should be a lot more. It's easy to buy a company when stocks are only going up, but if you think about it, that's actually the inverse of logic. Most investors want to buy companies that are growing fast and will be willing to pay a premium, whatever it takes to own this company, and it's for sure the wrong mindset. The stock market, it seems, if a company has low volume and is trading at a discount and it's really boring as an investment, nobody's interested in it. So here's a simple example using a banana. I'm sure you've seen it before. This banana is valued currently at $1. You go ahead and buy it because you know in exactly 1 year there could be a banana shortage, and this banana, for a fact, is going to $2 per banana. But tomorrow you wake up and realize that these bananas have been breeding like crazy, and now we're in the 2022 banana episode where bananas are taking over the world, and the banana price, because of supply, is now lower. The banana is now worth, your investment is now worth 50 cents on the banana. So what do you do knowing that this banana is going to be worth $2 still in 1 year's time? Do you sell it at a 50% loss, or do you buy more bananas, meaning that you now own more with a lower average, knowing your profit will be much more? Now, of course, the banana lasting 1 year is not going to happen because it's going to probably rot after a week, but I hope you get the point. Think discount, not danger. And this brings me on to tip number 4, which is probably the most important and the scariest one for all investors that I honestly feel most investors don't even care about, and that is margin and leverage. Using margin or leverage, or even taking out a loan to go and buy some stocks like me, Kevin, did, is a disastrous mistake in a stock market crash, because your broker at any point can call in, if your losses get too much, this investment, meaning you have to, no matter what, unknown, untold, realize the loss, take it on the chin like a champion, and have a really bad day. A stock market crash, trust me, is a lot less stressful when you don't have to worry about repaying a loan when your stock is down that you used a loan to go and buy, or indeed if you are using leverage to buy any company. The world is a lot less stressful when you're just using your own money, not somebody else's. Many investors just see the market falling and this is a great time to dollar cost average, but why would I use my money when I can use somebody else's and potentially reap the rewards of a stock market bounce? But remember, we don't know how long the recession's going to last, so you could be in debt for a hell of a long time, and your broker could still call you in. But simply put, in my advice, just don't use leverage and don't overreach when it comes to an investment. Your capital should be enough provided you are regularly investing. And on that, here's a little side tip, and that is that usually we always preach you should have a cash fund. My personal cash fund is making sure I have 6 months of life, and by that I mean paying all my bills, making sure I have enough money for food for the next 6 months. And usually in a market crash, I try and increase this to 1 year. And it might sound a bit crazy having so much cash in a bank account doing nothing. It could be an investment. It could be something you can quickly sell without losing too much money that you're not going to feel the impacts if you do indeed sell it because it's at a loss of 50%. But you have to think logically. During a market crash, you are more likely to lose your job because companies are cutting back their budgets. They're more likely to have financial insecurities when the world is crumbling around you. And here's an example. Robinhood, a huge company growing at a fast rate, just laid off 9% of its staff. The chances are that you are more financially vulnerable in a stock market crash, so try and make sure you not only have this safety net, but also enough money to constantly keep investing into your ETFs. I honestly think that people miss this fact about having enough money to pay your food and bills, but also have enough money to continue your investing on a regular basis. So if you don't have 6 months worth of life in investing in the bank, you really need to start saving. And that brings you on to point number 5, what companies to invest in. Simple answer is none. Don't invest in any companies. Because if you're watching this video, I have some very bad news for you. And no, it's not just that I've eaten your banana. Don't judge me. But the simple fact of the matter is, if you're watching this video, you probably shouldn't be buying individual companies anyway. A lot of companies in periods of uncertainty simply just don't recover. Cisco is a great example. In 2008, Cisco fell all the way down to the pits of hell. And to date, this company is massive and has still yet to recover. It can be hard picking the right business in an economical, tough environment. So why not just go and get exposure to the full stock market via an ETF like the VU or whatever your favorite is? Go and buy the whole market regularly, and then you can still have exposure while lowering your risk by a severe amount. And on that, if you've not started investing into ETFs, you need to. ETFs account for about 60% of my portfolio at any point. And during a stock market crash, this 60% can go all the way up to 90. I mean, if you think about it logically and you haven't started investing into ETFs yet, a stock market crash is literally the perfect place to start investing. But if I still cannot sway you with ETFs and you're adamant you want to buy stocks, then make sure you are buying companies that are offering huge amounts of free cash flow, buying back shares. It doesn't really matter about the dividend, in my opinion. Make sure they have good fundamental metrics. They will be around in 25 years' time. Make sure you're buying companies that fundamentally and foundationally speak with you and make sense. Not high-risk companies still yet to break profitability, because those companies are the ones who are going to dilute you when they can't get loans anymore. And a final point here is to reassure investors who are still panicking at the end of this video. Remember the famous Wall Street Bets quote, "Stonks only go up." But remember, as a collective and over a long period of time. Drop the code word down below, which is banana. And if you want to see members only videos here, value investing here, don't forget the chat room access via the link on the pinned comment. Be safe out there and good luck.